There's a pattern in history that has destroyed every offshore banking system that grows too large to control. And right now, in 2025, what happened to the $13 trillion Eurodollar system is following that exact same pattern, stage by stage, crisis by crisis, just like every shadow banking network that thought it was different. The London Eurodollar market completed all 5 stages of this cycle by 2024. 85% of the market migrated to a completely different structure. The offshore dollar system that powered global finance for 70 years is gone. 3 previous systems followed the identical sequence. The 1920s German banking system expanded beyond regulatory control, faced repeated liquidity crises, then required central bank intervention until it was restructured under domestic oversight by 1924. The 1960s London Eurobond market grew to dominate European finance, suffered stress events throughout the 70s, then was absorbed into regulated exchanges by 1986. The 1980s Japanese offshore banking system reached massive scale, endured the 1997 Asian financial crisis, then was consolidated under Bank of Japan supervision by 2000. 3 times, 3 offshore systems, 3 transformations into domestic control. And here's what should terrify you about the Eurodollar system. It already completed Stage 4 in March 2020 when foreign exchange swap spreads exploded 150 basis points and the Federal Reserve opened unlimited dollar facilities to 14 countries simultaneously. Financial experts told you the Fed's intervention saved the global economy, markets stabilized, crisis averted. That was the comfortable story. But on March 26, 2020, the Fed quietly eliminated reserve requirements for U.S. banks. No press conferences, no headlines, just a footnote buried in crisis management. That regulatory change triggered the largest migration in financial history. By early 2024, traditional Eurodollars had shrunk to 15% of overnight dollar funding volume. The other 85% moved into something called selected deposits. The same banks, same money, but now under Federal Reserve jurisdiction. The system didn't collapse. It transformed into something the Fed could control. And almost nobody noticed it happened. The surface story seemed straightforward enough. In March 2020, when COVID-19 shut down the global economy, headlines focused on stock market crashes and stimulus checks. Financial media reported that the Federal Reserve opened swap lines, emergency dollar facilities for foreign central banks. Markets stabilized. Crisis averted. The Dow recovered from its March lows. Treasury yields fell back to manageable levels. By summer, most analysts declared the financial system had weathered the storm successfully. But if you knew where to look, the data told a completely different story. In those same weeks when newspapers celebrated the Fed's quick action, foreign exchange swap spreads, the premium foreign banks pay to borrow dollars, exploded from 20 basis points to 150 basis points. That's not a minor technical adjustment. That's a 7-fold increase in the cost of accessing the world's reserve currency. The dollar appreciated 12% against emerging market currencies in 10 days. The Bank of Japan borrowed $225 billion from the Fed. The European Central Bank took $140 billion. 14 countries needed emergency dollar access simultaneously. This wasn't a normal liquidity crunch. This was the Eurodollar system screaming for life support. Here's what the financial press missed completely. By early 2024, the traditional Eurodollar market had shrunk to 15% of overnight dollar funding volume. The other 85% had moved to something called selected deposits, dollar-denominated deposits held in U.S. banks but structured like Eurodollars. The terminology shift obscured the reality. The unregulated offshore system couldn't survive in its original form. It had to be rebuilt inside Federal Reserve jurisdiction. The Federal Reserve eliminated reserve requirements in March 2020, the same month of the crisis. This regulatory change made it economically feasible for the Eurodollar market to migrate into domestically regulated instruments. The timing wasn't coincidence. It was emergency structural surgery on a dying system. When you eliminate the regulatory cost advantage that drove banks offshore in the first place, they stop going offshore. They bring their operations back under Fed oversight where they can access Fed support directly. The Eurodollar system followed the exact pattern of every offshore banking system that grew beyond regulatory control. Stage 1. Rapid expansion outside oversight from the 1950s through the 2000s. Stage 2. Increasing instability and repeated stress from 1998 to 2019. Stage 3. System failure requiring intervention in September 2019. Stage 4. Complete dependence on Fed support exposed in March 2020. Stage 5. Structural transformation or death from 2020 to 2024. When long-term capital management called the Federal Reserve Bank of New York to report imminent collapse in September 1998, regulators learned something terrifying. They had no idea LTCM existed at this scale. A hedge fund with $4.8 billion in equity had borrowed $125 billion from banks and held $1.25 trillion in derivatives, 250 to 1 leverage. Nobody tracking the system knew this concentration existed. LTCM's strategy was elegant in its simplicity, arbitrage tiny, price differences between similar securities. Low returns per trade meant massive leverage was required. Every dollar of capital controlled $30 of debt on balance sheet. Off balance sheet, through derivatives, the multiplier hit 250 to 1. The fund generated 43% returns in 1995, 41% in 1996. Nobel laureates Myron Scholes and Robert Merton provided the academic credibility. John Merriweather, former Salomon Brothers vice chairman, provided the Wall Street connections. Then Russia defaulted on ruble-denominated debt on August 17, 1998. Global markets froze. Investors fled to the safest assets, U.S. Treasury bonds. LTCM's positions, which bet that spreads between securities would narrow, exploded in the opposite direction. By September 1st, equity had fallen from $4.8 billion to $2.3 billion. By September 22nd, just $600 million remained. Here's what connected LTCM to the Eurodollar system. The hedge fund's counterparties were the major global banks who were also the primary Eurodollar dealers. These banks didn't just lend to LTCM, they had copied LTCM's positions using information from their clients' order flow. When LTCM needed to liquidate, the banks faced the same losses. Investment banks held LTCM's derivatives contracts worth $1.25 trillion notional value. A forced liquidation would trigger fire sales across treasury markets, repo markets, and Eurodollar markets simultaneously. On September 23, 1998, Federal Reserve Bank of New York President William McDonough convened 14 banks. They contributed $3.6 billion to buy out LTCM and prevent collapse. The Fed didn't lend its own money, but it orchestrated the rescue. Why? Because the Eurodollar-based global dollar system was minutes from seizing up. What LTCM exposed was the hidden architecture of dollar creation. Banks operating in Eurodollar markets faced no reserve requirements. They could create dollar liabilities without holding dollar reserves. This allowed extraordinary leverage until liquidity vanished. When markets panic, every bank simultaneously needs dollars. But dollars exist only at the Federal Reserve. Eurodollar banks operating offshore had no direct Fed access. The LTCM crisis showed the fatal flaw. The offshore dollar system was utterly dependent on onshore dollar liquidity during stress. The system worked perfectly in calm conditions. In crisis, it required Fed intervention. 10 years later, the numbers would be vastly larger. The Federal Reserve announced temporary reciprocal currency arrangements with the European Central Bank and Swiss National Bank on December 12, 2007, initial cap of $24 billion. Financial media reported it as technical plumbing. It was emergency resuscitation. European banks were scrambling for dollars, and the scramble was reaching U.S. shores. The federal funds rate was rising as markets opened because European banks were bidding up overnight dollar funding. The Eurodollar system had grown massive. By 2007, European banks alone held over $30 trillion in dollar-denominated assets. They funded this through short-term wholesale markets, including Eurodollar deposits that paid no FDIC insurance and faced no reserve requirements. When BNP Paribas froze 3 funds on August 9, 2007, unable to price U.S. mortgage securities, confidence shattered. Who knew what toxic assets each bank held? Lending froze. September 15th, 2008 changed everything. Lehman Brothers filed for bankruptcy with $619 billion in debt. Credit markets worldwide stopped functioning. The Eurodollar market, the presumed source of unlimited dollar liquidity, evaporated. Banks hoarded cash. 3-month LIBOR, the benchmark rate for Eurodollar lending, surged above 4.5%, spiking 350 basis points above the Fed's policy rate. The spread between Eurodollar rates and US dollar LIBOR, normally tight, exploded. This revealed the truth. LIBOR was understating the actual cost of borrowing dollars. Real funding costs in offshore markets were far higher. Foreign banks couldn't get dollars at any price. Within days, the Fed expanded swap lines to 14 countries. The cap jumped from $24 billion to $620 billion. Then, on October 13, 2008, the Fed took the unprecedented step. It offered unlimited dollar swaps to the ECB, Swiss National Bank, Bank of Japan, and Bank of England. No cap, no limit. Borrow as much as you need. The European Central Bank drew $300 billion at peak. The Bank of Japan drew over $120 billion. In total, the Fed made more than $10 trillion available through swap lines during the crisis. Peak outstanding balance hit $586 billion in December 2008. This wasn't a rescue of foreign economies. This was a rescue of the global dollar system that American banks and investors depended on. U.S. money market funds held billions in European commercial paper. U.S. banks had funded themselves through Eurodollar markets. If foreign banks failed, U.S. institutions faced catastrophic losses. The swap lines worked. By announcing unlimited support, the Fed put a ceiling on panic. Banks knew they could get dollars through their central banks. The Eurodollar LIBOR spread began narrowing. By May 2009, the system had stabilized. But the core truth went unspoken. The Eurodollar system could not function in crisis without the Federal Reserve acting as lender of last resort. On Monday, September 16, 2019, the secured overnight financing rate opened at 2.43%. 24 hours later, it hit 5.25%. During intraday trading, repo rates spiked as high as 10%, 5 times the Fed's target rate. Borrowers in the repo market were paying 300 basis points above the Fed's policy range. That's a 30-fold increase in spread from the previous week. This wasn't a foreign crisis. This was the U.S. domestic plumbing exploding. The Treasury Department settled $78 billion in government debt on September 16th. Corporate tax payments for Q3, $35 billion, were due the same day. This drained $113 billion from the financial system simultaneously. Meanwhile, reserves at the Fed had declined to $1.4 trillion, the lowest level in years. Banks, constrained by post-2008 liquidity regulations, couldn't quickly deploy reserves to arbitrage the spiking rates. At 9:30 a.m. on September 17th, the Federal Reserve injected $75 billion into repo markets. Rates began falling in some market segments, but remained elevated in others. The Fed continued $75 billion daily injections for the rest of the week. Over the following months, the Fed would inject an estimated $400 billion. What September 2019 exposed was the fragility of the so-called ample reserves framework. The Fed thought $1.4 trillion in reserves was ample. It wasn't. Banks needed reserves for regulatory requirements and chose to hold them rather than lend in stressed overnight markets. The money market, including Eurodollar markets, revealed its dependence on Fed support even in a minor stress event. Then COVID-19 hit. On March 11, 2020, the World Health Organization declared a pandemic. Global trade froze. Countries that earned dollars through exports, their primary source of dollar funding, lost that income stream overnight. Every foreign bank, every foreign company, every foreign government with dollar debt needed dollars immediately. And there was nowhere to get them. The foreign exchange swap basis spread, the premium to borrow dollars against foreign currency, exploded from 20 basis points to 150 basis points for major currencies. For emerging markets, spreads were even wider. The US dollar appreciated 7% against major currencies in 10 days. Against emerging market currencies, 12% appreciation in the same period. On March 15, 2020, the Federal Reserve slashed swap line rates by 25 basis points and announced 7-day and 84-day operations. March 19th, the Fed added 9 temporary swap lines, bringing the total to 14 countries. March 20th, daily swap operations announced unlimited frequency. March 31st, the Fed created the FIMA repo facility, allowing foreign central banks to swap U.S. Treasury holdings for dollars. Japan drew $225 billion. The European Central Bank drew $140 billion. The interventions worked, but they revealed the terminal diagnosis. The Eurodollar system could not survive even temporary disruption without total Fed support. In the same month the Fed opened unlimited swap lines, it made a seemingly technical change that would reshape global dollar markets. The Fed eliminated reserve requirements for U.S. banks. Effective March 26, 2020, reserve requirement ratios were reduced to 0%. This wasn't mentioned in major financial headlines. No press conferences. No dramatic announcements. Just a footnote in crisis management. But this regulatory change made it economically feasible for the Eurodollar market to migrate into domestically regulated instruments. Before 2020, Eurodollars and selected deposits split the overnight dollar funding market roughly 50-50. Selected deposits are dollar-denominated deposits held at U.S. branches of banks, technically onshore, but structured to function like Eurodollars for foreign bank branches. By early 2024, selected deposits made up 85% of overnight volume. The traditional Eurodollar market, dollar deposits held entirely outside U.S. regulatory jurisdiction, had shrunk to just 15%. With zero reserve requirements, U.S.-based deposits no longer carried the regulatory cost disadvantage that drove the Eurodollar market's growth in the 1960s and 70s. Banks could hold dollar deposits in U.S. branches without locking up capital in non-interest-bearing reserves. The offshore advantage evaporated. Foreign bank branches operating in the U.S. shifted funding from offshore Eurodollar deposits to onshore selected deposits. Same banks, same counterparties, same overnight funding, different regulatory structure. One crucial difference: these deposits now fell within Federal Reserve oversight and emergency lending access. The Eurodollar system's core feature was its independence from Federal Reserve control: no reserve requirements, no FDIC insurance, no direct Fed access. This allowed banks to create dollar liabilities without regulatory constraints. It also meant they had no Fed backstop in crisis. The 2020 transformation eliminated this independence. The new structure operates within Fed jurisdiction. It has Fed access. It can receive Fed support without the political and operational complexity of international swap lines. The Eurodollar futures contract, launched in 1981 as the first cash-settled futures contract, trading on the Chicago Mercantile Exchange, ceased being a relevant benchmark for actual Eurodollar funding costs. The market it was designed to hedge had fundamentally changed structure. Research by Federal Reserve economists in 2024 documented the shift in dry technical language, changes in regulation, and in economic conditions in the U.S. banking system have contributed to the narrowing of differences between Eurodollars, selected deposits, and Fed funds. Translation: they're the same thing now. The Eurodollar market, as originally conceived, is gone. This is how offshore banking systems die, not with collapse and panic, but with quiet transformation into something domestically controlled. The name survives. The regulatory independence dies.